Amanda Cassatt, and this is Endgame.
Staking is the first truly native form of yield, which itself is completely global and decentralized.
How has it changed from the beginning to now?
Institution in the space now has changed dramatically. I think, one, because the technology in the space is maturing.
Who's not able to stake yet, or who's not doing it?
I think that there is a big slug of incumbent banks that I think will be looking to extend staking inside of their offerings. Banks, particularly in the U.S., have generally been extremely constrained.
And so this whole non-correlated idea. So the same way that people have lauded Bitcoin as being a hedge against the global macroeconomics falling out of whack, World War III, the apocalypse, there's a way in which this is even safer yield than TradFi yield, or even than Treasuries, because it would remain unaffected even by a catastrophe happening to a major government.
I think there's a much more heavy placement and focus on self-sovereignty and the ability to sort of own the data that you create or the value that you create. And I'm hopeful that we as a society can sort of move in a direction where the economic models that we use on the internet are less extractive and actually more positive sum in the way that we can use this technology and sort of implement it holistically.
Mara, we briefly intersected at Consensus, but can you tell everybody your origin story of how you got into the space and built Alluvial?
Yeah. First of all, great to be here, Amanda, and excited to jump on and share a little bit more about my journey and, what we've been up to. Okay, where's the best place to start? So, how did I get into crypto? Unfortunately, more from the research side than the trading side of the house. It's kind of interesting. I have one of my cousins actually got into Bitcoin really, really early and then passed along some of the earliest publications on Ethereum. I think this will probably resonate with you. You're studying economics, you're incredibly interested in incentive design and public goods architecture. So, it seems like something that you might be interested in from a research perspective. So I kind of fell down the rabbit hole pretty early. I was working in management consulting at the time, but I found myself listening to podcasts on the way to work, pretty much at work, and then on the way back from work. So I had started catching the bug. We intersected at Consensus, which was also actually my first full-time gig in the space. I joined the London office, which was the first international office out of the Consensus sort of organization. And I think with that, kind of the first foray, not just into working full-time in the crypto space, but also actually intersecting with some of the earliest, businesses and enterprises and even banks that were trying to figure out what to do on Ethereum, how to interact with Ethereum, and then, really figuring out what the first use cases around this technology would be. I started getting quite excited about Ethereum's migration from proof of work to proof of stake. That ended up consuming most of my time between probably 2019 to 2020 after having joined Consensus in 2018, mostly because it felt like in the really early days of enterprise Ethereum and figuring out how to bring enterprises onto Ethereum, there was a ton of proof of concepts and a lot of marketing spend, I think, in exploring how the technology could help solve certain issues in supply chain and healthcare and key considerations and trade and in the financial space and elsewhere. But staking to me felt inherently different. Maybe one of the first usage or adoption patterns that I could see institutions adopting fully on-chain and truly as a decentralized technology and innovation. And so got very, very excited about that. Ended up spending a lot of time after the release of the Serenity spec, diving into the staking rabbit hole, left Consensus for a company called Bison Trails that was becoming the leading staking infrastructure provider at the time. Bison Trails got acquired by Coinbase in February 2021 and started already at that time kind of conceptualizing what, was sort of the early innings of what became Alluvial and Liquid Collective in 2022. So happy to dive into more of that, but it feels like last couple of years really just been focused on bringing institutions and also mainstream adoption into the staking space because I've been really, really, truly excited about this technology and innovation pretty much from the get-go.
Can you super briefly explain what staking is and what about it made you so confident that that's going to be where the real money pours in?
So staking is a consensus mechanism or a mechanism by which a network and a blockchain agree to truth across its ledger. Staking is in its simplest form is basically taking a crypto native asset like Ethereum, depositing it into the blockchain where it provides security in exchange for the right to contribute to network consensus. And for that right to contribute to network consensus, participants or stakers that deposit these crypto native assets earn rewards. Those rewards are natively produced by the blockchain. It's a new type of agreement, I think, or digital work agreement, if you will, that we haven't really seen in that kind of way. So participants are both contributors to a public good, but also recipients of rewards for providing and contributing to network security. Why did I think that institutions would start onboarding to that technology maybe sooner than tapping into DeFi or, using blockchain for other use cases? Is because it feels like a very natural analogy to certain financial services that institutions might be more comfortable or used to. In some ways, staking also presents what I would consider something that resembles more of an alternative income diversification stream. This continuity ability to earn predictable rewards for participating in a technical service seemed like something that institutions, portfolio managers, asset managers, and other market participants would find interest and appetite in. And for me, it was really in the early days about figuring out how can you make this as secure, as robust as possible so that we can onboard, these types of market participants in the future. And feels like, the future is starting to be here. So
Let's talk about the analogy to traditional finance. So, when you're talking about yield on treasuries, on bonds, something like 3, 4, 5% maybe, that's the analogy I assume you're drawing between the TradFi world and staking. But in TradFi, it's pretty clear what that yield comes from, and it's borrowing against the future growth of the economy, right? And so it's tied in some way to, betting on future economic growth of a certain country. Where does the yield come from in staking?
it is actually an interesting analogy. So, when you think about T bills, the container of this structure is basically the national economy's ability to issue rewards or to issue yields against an economy's growth. And market participants, obviously, you have fluctuants, but if you want to think of it this way, it's really the government that issues these types of notes or this type of debt. And that basically pays some consistent or fixed yield against it over a certain period of time. Now, the container in which this happens is one, the national economy, and also that kind of structure is always subject to monetary policies and sovereign policies that, tie into the broader national structure, jurisdictional structure of that economy. Staking is quite different. It has no jurisdiction. It is literally global and fully decentralized. In staking, rewards are issued by the protocol, not a government, right? In most cases, protocols follow certain predetermined inputs and outputs as it relates to how this yield is computed, but it doesn't really impacted by any type of monetary or sovereign policy. So you can almost think of it as uncorrelated to how you would think about participating in T-bills or investing in national economies or national debt. And I think that's fundamentally different. I think that's also one of the things that we're starting to hear from market participants that are starting to think of staking rewards more as an uncorrelated, diversified income play, as opposed to, kind of observing what government debt looks like and participation in those kinds of structures. How is the staking reward rate determined? Depends on the network. Different networks have different parameters, different dynamics by which they operate. I think in general, they do have something in common, which is that the participation in staking, if you think about staking as a contribution to a security budget, similar to how participation in traditional debt-like instruments is a participation inside of the constructs of the corporation, the government, that people sort of subscribe to and opt into the growth of. It's kind of similar inside of blockchains. The more participation there is in staking, the higher the security budget, the more difficult it becomes to corrupt, attack, or otherwise, kind of skew the outcomes of a particular network. And so over time, what you've generally see is a trend downwards on these participation rates, although in some cases they end up being dynamic. So let's talk about Ethereum, for example. In Ethereum, you have a dynamic adjustment. That dynamic adjustment has absolutely nothing to do with what's happening in sort of the outside economies or national economies or any type of monetary policy, but really depends on how high is the opt-in rate in staking and what is the corresponding reward rate or issuance rate of the network. When participation in network security is really high, reward rates trend lower. So today, for example, we have reward rates around 3%. Those were historically much higher when there was much less stake inside of the network, and therefore the security budget or the need for security was much higher. And so higher staking rewards attract more capital, more participation in staking, and then again increase that security budget. So it's a dynamic system. The parameters are somewhat defined, and that creates a certain type of predictability inside of the system as well, which I think institutional market participants appreciate that sort of understand these kinds of mechanics.
And so, this whole non correlated idea. So, the same way that people have lauded Bitcoin as being maybe a hedge against the global macroeconomics falling out of whack, World War III, the apocalypse, there's a way in which this is even safer yield than TradFi yield or even than Treasuries because it would remain unaffected even by a catastrophe happening to a major government. Is that the argument?
Yeah, I look at it like that sometimes. Like when you think about bonds and treasuries, it's the risk-free rate of the national economy that you're participating in. So like the T-bills are the risk-free rate of participating in the US economy. Staking is the first truly native form of yield that is native to the internet economy, which itself is completely global and distributed and decentralized. And because that native yield does not have or is not correlated to any particular monetary policy, I do view this as a diversification bet when you think about or relative to other forms of yields that are earned through off chain, and existing structures.
Can you explain what an LST is and why people might be concerned that they actually add more risk to the system?
Yeah. So in staking, most networks have embedded mechanisms that introduce some types of friction to capital efficiency. So when you participate in Ethereum, for example, and you stake your ETH to start earning rewards and participating in network security, you have something that's called an activation queue. Now, when you exit, decide you want to withdraw your ETH from the network, no longer participate in staking and claim your ETH back, you have something called a withdrawal period. Both the activation and withdrawal periods are dynamic, just like the security budget adjustments are dynamic. And so what can happen is that, entry queues and exit queues actually end up getting really, really long. And that actually happened recently, and it's a really good example of just how dynamic that system is. We had an operator called unbonding period. I think it's very difficult for a market participant to digest that doesn't necessarily understand the inherent mechanisms of the network. And so it's a UX friction. I think that's ultimately reducing opt-in rates on major retail platforms, retail brokerages, or otherwise. If you are an ETF, for example, that is even more complicated. So we had Grayscale actually go live with their staking ETF in the US last week, first US ETF that has actually gone live with staking. And we expect, after the US government shutdown, that we'll have, Fidelity and the BlackRocks and the likes also going live with this functionality. Now, ETFs have T+1
And those
redemption.
are all on Alluvial?
We haven't disclosed or publicized any of the relationships that we have with the issuers, but we've been working very, very closely in
Got it.
designing, particularly our stake management system around their needs, um, which address particularly this area, right? The sort of the ability for them to serve their liquidity needs and as maximally flexible as a way of that's possible for them, whether it's through native staking or through the LST or using a mix of blend of those two strategies to support their funds and also their management.
So, mechanisms like LSTs, mechanisms like restaking, these are things that aren't possible to do with treasuries, with kind of the TradFi comparable, but they're things that are possible to do with crypto. Aren't those mechanisms introducing more risk into the system in order to be able to place higher bets? Like, how are those kinds of practices not making the system more fragile?
I think it's an interesting question and also a healthy perspective. I think for LSTs specifically, you kind of take like the balanced approach of like, is this net safer or less safe than using native staking? And I think the categories that I would use to like classify that in is LSTs introduce a number of technology innovations. So LSTs are basically a receipt that is issued against an underlying staked position, and that receipt is issued on chain. So it's no different from issuing a receipt for a warehouse bill if you're storing corn in a silo, or if you get a receipt for completing a purchase in sort of the traditional world. But it does help create additional flexibility in moving those assets around, selling them to another counterparty, maybe even collateralizing them and being able to create like a more productive use of the assets. I think with LSTs, a number of innovations actually make participation in LSTs or the use of LSTs safer than just potentially just using an at-home setup or potentially just using a single operator. Because in most cases, and like what we do on the liquid collective side, there's multiple operators on the back end, so you're mitigating single points of failure risk or correlated failure risks. there's a number of security and protection mechanisms that are built into the protocol. And in most cases, people have layered insurance programs that exist on top of that, just in the event that something does happen. Where there's an added layer or new layer of potential risk is really on the smart contract side, which is net new. When you participate in traditional staking, you're really only interacting with the Ethereum smart contract or deposit contract. You're not really interacting with any other contracts in most of those instances. With liquid staking, a lot of the architecture revolves around smart contract support to facilitate both the deposit, the issuance of the on-chain receipt, and then withdrawal mechanisms around it. The one thing that I will say is quite different from DeFi, where, smart contracts tend to create these honeypots. You basically deposit in a lending protocol and then assets sit there for a really long time. And then, there's numerous cases where, there's been vulnerabilities that have been exploited. With liquid staking smart contracts, they're usually more of a pass through. And so assets really only sit in the contract or get moved through the contract over the course of a couple of minutes before they end up in the deposit contract. And that is a material difference in sort of the security vector. Do I think that it introduces a material amount of additive risk? I actually think that staking has become quite safe. We've had very few material slashing incidents on Ethereum, even since the Beacon chain went live in December 2020. I think operators have worked very diligently to increase their security posture, key management frameworks, and other things that I think have contributed to security more broadly. And in many cases, I actually think that LSTs that are designed with the right security parameters and the right architecture are actually just going to serve as a better way to unlock new collateral cases and DeFi support more broadly. So that's kind of how I think about it. If you have ETH sitting somewhere, and like that's a really good example of this, if you have ETH sitting somewhere and your mandate maybe as a DAT is to increase ETH per share. An LST is really the only way that you're going to unlock anything beyond baseline yield, unless you want to enter into really complicated centralized counterparty arrangements. If you want to unlock anything in DeFi, you today either have to make the trade-off, okay, stake, earn 3%, or participate in DeFi and not participate in staking. LSTs really unlock the ability for those types of counterparties to do both in a fairly secure manner, particularly if they choose, kind of blue chip institutional grade solutions that meet their security and compliance needs.
Let's talk about the technology that makes this all possible, which is staking itself. So I started working, and I think you did too, on Ethereum long before it had instituted proof of stake. And I actually remember hearing about blockchains like EOS that were secured by networks of validators instead of by a more decentralized proof of work mechanism. And so my mental model back in 2015, 2016 was this proof of work mental model where by doing work, you can understand the price of your asset in context of something that is priced outside your network, something like energy, something like compute, so that your price isn't completely self referential. And the potential to be more decentralized seemed to come with proof of work. Um, and the whole argument against an EOS like chain and then against Solana type chains is that they're too centralized. And that type of system is vulnerable in that way. But then, which was always part of its roadmap, but then Ethereum introduces this same kind of validator based system that we once scoffed at and scorned when it was EOS who was introducing it. And so I guess, can you steelman the case against proof of stake? Was there anything lost in the transition from proof of work to proof of stake here? And how does staking decentralization on a network like Ethereum or even a network like Solana, how decentralized is it?
Yeah, it's honestly a great question, and it's really interesting to have, frankly, even witnessed the transition of something as substantive as Ethereum's consensus mechanism since we started in the space. Ethereum made a couple of very thoughtful design choices very early on that I think are quite distinct from other networks. I think a lot of the early design principles, the Serenity spec, this was pre-implementation and before, proof of stake actually rolled out, really centered around the ability of being able to use a traditional consumer laptop to participate in staking. That anyone that had ETH available to them in a 32 increment now, even through some solutions, fractions of that, would be able to participate in the security mechanism of Ethereum. And there was a lot of investment very early on, which I literally have not seen any other network do. in funding some of the core components that would introduce a diversification at the infrastructure level. So think about execution layer clients, consensus layer clients, the amount of market participants that's sort of layered into that technology, which I think continues to be just unparalleled in terms of, the kind of diversity that we've seen. And also, frankly, the continued participation or the continued support from the Ethereum community and driving towards things like client distribution and diversity in a meaningful way to sort of mitigate, major centralization and correlation risks. Ethereum also has this interesting mechanism, which I do think is quite intelligent, in that the incentive to centralize is built as a disincentive into the network. It's called correlated slashing. And then I think there's numerous discussions around introducing potential penalties for correlation and attestations as well. And so the network actually kind of exponentially grows the punishment of how certain network outages or potential, slashing incidents are punished, depending on how many nodes in the network actually go down at the same time, which actually disincentivizes market participants from correlating or basically concentrating in any given region, on any given gal provider, on any given client, and frankly, also with any given provider. And I think there's continued reasons why, when we talk to large scale asset managers or large scale institutions, not a single one of them is using a single operator ever at this point. I don't think I've seen that in a really long time, especially the more, risk conscious participants really understand this sort of nuance in Ethereum's architecture. When Ethereum went live, I want to say, so it was my birthday, December 1st, 2020. The chain launched. And
What a present.
yeah, what a present. It was really fun. I feel like we had like a launch party and watched that. But yeah, so December 1st. And then I think so that was bootstrapping phase. And then I think the network officially kind of launched in early 2021. The network was really quite centralized. And I think the reason for that was there wasn't a lot of really sophisticated participants that could run Ethereum sort of at scale. And you kind of saw these pockets of large operators that had ultra high concentration, and those operators served everyone, right, from the largest exchanges to the largest custodians to basically anyone and everyone that
Mhm.
was participating in the space at the time. That landscape has changed dramatically in the last couple of years. I think for a number of reasons. Operating nodes is becoming increasingly commoditized. There's a reason why lots of businesses are choosing protocols that inherently orchestrate many different operators on the back end because it's a security feature. And so choosing a single operator is becoming much less viable of a strategy. Therefore, there's not as much concentration around this. Lots of businesses are viewing staking as just an inherent competence. And I think that's going to continue when you think about, banks offering a full stack of services, or, brokerages offering a full stack of services. Staking kind of just sits inside of that. And so you're seeing more and more diversification because these businesses either are investing in building out their own competences, or they're acquiring other businesses, smaller businesses, and kind of serving some of their own market needs. And so you're seeing a much more diversified landscape, I think, in terms of participants. And you're seeing a lot of new technologies that actually also make it increasingly more safe to use much smaller, more independent operators, or even to run your own nodes. And I think distributed validator technology has done a really amazing kind of work and in that particular space, and enabling different nodes to sort of interact and have failover protection, so that operators at home and little squads, or maybe even market participants that are larger, can sort of interoperate and create the right security measures. So protocols like Lido or protocols like Ether5 feel confident onboarding more and more at home or independent operators to sort of contribute to the network without, compromising security. And I think we're seeing more and more of that sort of diversification and decentralization building into the network, which is great, I think, relative to what the concerns were, I think, that we kind of all saw and voiced, a couple of years ago when proof of stake initially rolled out.
Makes sense. So, looking at your beautiful Alluvial website, one can read words like institutional and enterprise grade. And with staking becoming competency, and with the landscape of providers getting as diverse as you're describing, what do those words mean? And what are the kind of hard criteria that stakers differentiate on?
Yeah, I've always in crypto kind of worked on the intersection of And the word institutions has changed a lot also in terms of who's actually participating. I think we use the term very loosely, like an
How has
institution
it
is a crypto
changed?
VC.
I think it could be, yeah. Yeah, it could be
Yeah.
useful to say,
How has it
how has it
changed?
changed from the beginning to now?
Institutional capital in the beginning, or like in the last couple of years, I think institutional capital mostly refer to VCs or maybe hedge funds, prop shops that were using crypto in some material way, or that were serving or served through some of the custodians that we all know, a Coinbase or an Anchorage or a BitGo. What an institution is in the space now has changed dramatically. I think one, because the technology is maturing, but also because the regulatory environment has made it possible for some of these market participants to enter the market. So think regulated public companies, DATs, of course, we've spoken about that in the beginning, exchange traded product and exchange traded funds that are regulated and basically broaden the universe of access. Now market participants who might not be able to, for compliance reasons or otherwise, hold crypto directly on their balance sheet can actually hold crypto passively by participating in ETFs. We are seeing more and more, regulated counterparties and banks, fintechs, and other brokerages entering the market that are what I would call incumbent, or market participants that not have traditionally engaged with crypto. I think that's changed materially in the last year alone. And I would say even more so this particular year, as we've seen guidance from the SEC on staking get released, and then follow on guidance on liquid staking in August, which was obviously like a pretty big watershed moment for the industry. So I think, yes, the definition of what an institution is has changed, but I think the requirements are quite distinct and I think different from what I would maybe call more crypto native solutions. So me as a crypto native user, I have a ledger or ledgers, and I enjoy going and using a dApp and being able to kind of, in a particular staking case, like minting a receipt on my stake position and then basically using that and plugging that in and then using DeFi and all of these things. And that requires, I think, certain technical literacy, but then also just like the willingness to interact with the technology in that way that maybe businesses are precluded from doing. When you are a larger scale company, especially if you're regulated, you have a plethora of things that you have to think about. Who are the counterparties or the vendors in an underlying solution? Like, do they meet the standards or requirements that I might have, whether it's ISO or SOC 2 or other things? What kind of security measures are in place? Like, are those documented? Are those certified? What is the compliance posture? In what jurisdiction? What do they have to basically obligate themselves to do, whether it comes to, KYC, AML, OFAC, all of these kinds of things? That's inherently different from just like plugging in a ledger and using an app. It's a good thing that we
Totally.
have more consumer facing products and maybe also more institutional or B2B facing products, and that those I think ultimately can also interact in sort of the decentralized finance space. So I think it's really those terms. I think specifically, and kind of the story of our business was that we were looking at, figuring out how to implement LSTs within both within Coinbase, but then also like other businesses that, we were collaborating and working with at the time. And we just kept hearing the same and same concerns again, over and over and over again, which was, we're not sure that we're comfortable implementing with counterparties that are unknown or that are really broad and that, we've never met and that we can't even certify where they're based, operators that might be running in different jurisdictions or may have different security protocols. We also heard that this concept of like ETH going in, ETH coming out, you're actually not sure whose ETH you're getting back. That was also really difficult, I think, for compliance teams to digest. Um,
And you
it's
can't
like,
just
wait,
tell them what
whose ETH
eats
is
are
that?
fungible
Like,
with each other?
yeah, it's like, how do I know where this came from? Like, will people get comfortable with that? And then also, I think like the difference between like pricing models, right? Like consumer facing pricing really, really different and willingness to pay really different from institutions where you have ultra high velocity, but also much more pricing power and compression. And, it's just different types of structures. We kind of saw an opportunity to bring together market leading businesses, whether they're custodians or exchanges or prime brokerages or fintechs or operators, and kind of bring them together to say, hey, what's the kind of market standard that we're all comfortable with so that we can build network effects and build really strong liquidity and market participation and ultimately offer a much better service to customers than them having to use a bunch of different fragmented solutions. Kind of what happened in the stablecoin space too, right? Like 2018, everyone and their grandmothers was issuing a different stablecoin. That didn't necessarily mean that it was the best approach for customers to have all of these different solutions instead of, being able to access like a USDC across different access points and venues so that it actually ends up creating a lot of value and utility for the end user. So we felt really strongly about that, and that's kind of the philosophy around which we built Liquid Collective in the beginning, with Coinbase and Kraken and Figment actually coming together to sort of serve as design partners and integration partners to the business. And today, with 30 plus different platforms, custodians, asset managers and prime brokers sort of integrating this sort of standard that they can all use and holistically offer to their customers.
And so, why didn't every staking company do this? What was their different strategy from yours?
I think it depends on how you look at the layers of the stack, but like node operators run the actual hardware and the actual infrastructure, and also in some cases the software to support staking. Liquid staking is more like orchestration and receipt issuance. So like orchestrating multiple different operators to work together to have a hardened security posture, and then actually kind of living one layer above the stack to then issue these receipts and provide integration points. Why didn't different staking operators build this? I think in the first part, because it's very hard for one staking operator to then make another staking operator integrate whatever they've agreed to build. The same problem
Sure.
exists with, if one custodian builds an LST, like why would the other custodian use it? And so we always felt like it had to be neutral, which is also why, for example, on the node operator side, like we work with Figment and we work with Coinbase and we work with Staked and we work with Galaxy and we work with Blockdaemon. Like we kind of view our technology as synergistic to them. Like the way that I view it, like I would love for them to just be in a position to say, hey, customer A, like, would you like to just use native staking? Or you can also use this Liquid Collective product, which is inherently an extension to their service offering, as opposed to something that like upends or like, changes or substitutes what they offer in the market.
That makes sense. I guess staking seems like such a no-brainer to me for anyone that has a big pool of an asset that is stakeable. And so my question is, who isn't there yet? Who's not able to stake yet, or who's not doing it? DATs, ETFs, like who are the laggards who has yet to be onboarded?
I think that there is a big slug of incumbent banks that I think will be looking to extend staking inside of their offerings. Banks, particularly in the US, have generally been extremely constrained on what they've been able to do under SAB 121, which was rescinded a couple of months ago, and so slowly starts opening up what banks are able to offer in terms of services when it comes to cryptocurrencies. And I think staking, as I said, almost feels like a usage pattern that's kind of early: custody, trade, and then probably staking in terms of what you can do with assets. So I think seeing more and more banks participate in that space, I think is going to be a shift. I think that we'll see more and more traditional fintechs and retail brokerages entering into the fold. I think the most material constraint for those types of market participants has been regulatory. People have been relatively conservative, particularly in the US, in the absence of any regulatory clarity around staking or, innovations like LSTs that make these products more usable, more user-friendly. I think a lot of that is changing pretty quickly, at least from what we're observing and who's entering the chat on our side and who's starting to ask about, being able to extend these services to their clients. So I think that's a lot of the market of kind of where I see a lot of the next couple of years going. But I will say that, as I said, like the last year has been a material change. I think ETFs being able to offer staking as a material change. I think that public companies using not just ETH as a treasury asset, but actually using its productive nature, distinguishing its productive nature, and being able to participate in staking and generating staking rewards is a material change. So I think we're slowly getting there. I think the very last laggards on that will be, sovereign wealth funds, pension funds, and other much more conservative incumbents that are slowly going to be able to sort of enter into the fold, either directly or through vehicles like exchange traded funds that make it easier for them to hold and participate in staking rewards either actively or passively.
Do you think that building in crypto at this point is a competition over the best technology, or that it's about access to regulators and BD?
I think the winners of this next cycle are going to be distribution. If you have a strong distribution and you have technical competence and you know how to show up in the market at the right time, that to me strikes me as where we're going to see a lot of that unfold. And we frankly are. When you start seeing a lot of these incumbent players with massive distribution networks, access to both retail and institutional customers and IRAs and a lot of other stuff kind of entering into the fold, it really becomes a game of how can you make this technology as accessible and broadly distributed as possible. And I do think the smartest people have already been investing and building out these competencies behind closed walls and have just been ready to kind of flip the switch and get things moving. So I think we'll definitely see a lot of that. It's really those who, kind of refuse to onboard to the technology, who maybe have not had confidence in the regulatory climate or who generally just felt like they could sort of sit back and wait. I think that will be most disadvantaged even if they have the distribution networks in place. I think on the back of that, we'll probably see a lot more consolidation in the market and a lot more, incumbents acquiring like existing technologies to sort of be able to level up and sort of meet the market where it's at.
It's a great time to have already been building a staking business. That's for sure. So let's talk about these seams and the sinews connecting staking and the yield that comes from it to DeFi. Some, not all, of the yield offered by DeFi products originates in staking. What do you think about DeFi yields and about the way in which staking ends up driving DeFi growth?
I think that we're kind of seeing the early innings of this already with what's happening in the debt space as maybe one of the first segments that is really seriously looking at how to combine baseline staking yield with DeFi participation, the vehicle for that really
Hmm.
being LSTs. And I think it's interesting because it really forces, I think, the market to consider what the easiest way is to move from one to the other and also what kind of existing infrastructure challenges exist. And like I'll lay out one to you that I think is quite material and I think hopefully we'll get kind of work through in the next couple of months. But most qualified custodians, which is where most of these DATs today need to custody their assets, do not actually have direct access points to DeFi. You usually have to move assets to a hot wallet or an on-chain
Hmm.
wallet to then be able to participate. I think that's going to change. And having QC native access to DeFi is going to be much more of a table stakes interaction in the coming months. There's going to be lots of things still to be worked out, both on the regulatory and then also on the tax and accounting side as it relates to DeFi interaction. But there's enough pressure, I think, with the very billions and billions of dollars in DAT volume that are really trying to participate in the market and ramp up, that there's sort of an impetus to kind of work through those things. I think that what we're seeing is people participating, or when they look at DeFi, really kind of segmenting out what they think is the least risky participation. And DeFi, particularly in lending markets, probably comes up very often
Hmm.
as one of the blue chip solutions that people are comfortable with, more comfortable maybe than using other products where they feel like the risk profile is higher. But it's really exciting to start seeing kind of that convergence happen, and not just the convergence in demand, but actually the technology solutions that are, and different participants in the market being able to sort of bridge that access from what has been materially more off chain to now actually being able to bridge into on chain markets and the DeFi space more holistically.
I love that because I really resonated with Vitalik's blog post about low yield DeFi being the first non-embarrassing potential big revenue driver for Ethereum, kind of like what Google search was for Google, which enabled them to fund all kinds of other really interesting, but maybe without as obvious a revenue kinds of businesses. And I guess to that extent, where there's this kind of seam and this flow between staking and institutions coming in and DeFi, that seems like a potential catalyst for the growth of the on chain world. And that means the kind of permissionless, accessible, immutable part of the world, as opposed to the more kind of permissioned KYC'd halls of those spaces. In that spirit, as someone who's been in the space a while, are these technologies still a Trojan horse for changing the world and making it more open and permissionless and accessible to all? Or are they a portal to everyone getting KYC'd to Cory Doctorow style enshittification? In 20 years, are you going to need to, KYC in order to use blockchains at all because they've been captured? What's your vision of the future? Which way do things go?
I think I'm leaning much more optimistic, also because I think we're seeing the innings of that convergence happening. One of the coolest things, honestly, that I've seen recently is Coinbase's like native Morpho Bitcoin lending integration. That is a beautiful example of connecting like a more traditional centralized exchange service with like the power of like just underlying DeFi technology that is inherently permissionless and that
Mhm.
can actually benefit from that can actually benefit users with its architecture. I think we're gonna see much more of that connectivity happen where to me, like being able to capture the entirety of the market also means you have to sometimes serve users in places or from places that where they're comfortable. And that means that being able to cater to users through different front ends or maybe experiences that they're used to, but still being able to kind of bridge them in to the on-chain world through user experiences that they're used to and that kind of like slowly bring them into the fold of the potential of what DeFi has to offer. Like that to me is like a beautiful co-evolution of both worlds where it's not as black and white, but really kind of those things starting to coalesce and sort of benefit customers holistically, whether you're onboarding, through a self-custodial wallet or a SEX, or maybe eventually like your Fidelity retail brokerage account, and really being able to leverage the benefits of what DeFi has to offer, either under the hood or directly, because you're sort of being bridged into those experiences. So I'm much more optimistic on the future and in terms of being able to sort of harness the potential of those things to maximally benefit users and ultimately, value creation in the space.
I guess my question is also this, right? Like, in order to make a Gmail account at this point, you need to KYC. When I originally made my Gmail
Is
account,
that true?
you didn't
I
need to
haven't
do
made
that.
one in a long time.
It's true. Yeah, it's true. And the reason for that isn't because some government forced them to. The reason is they want to build an advertising profile for you because that's still mostly an advertising business. If a single endpoint or set of endpoints have the best UX, because, right, you could go to Proton Mail, you can still create a non KYC email address, but it's just harder to, it's more unusual to. But let's say all of the most user friendly endpoints all end up getting an incentive, maybe advertising, maybe something else, to permission and to cut off and to restrict. What inherently stops that? What makes this technology not become like the internet, which I think most people can agree did a lot, but not necessarily what its early builders envisioned?
It's such a good question. I think a part of that for me is the fact that the why behind these business models and why they require this type of value accrual mechanism. Right now, data is the digital gold of everything on the internet, and if you're can't believe you actually have to KYC to create an email account. Actually, like very surprised about that reality. But the truth is, like that's the monetization framework behind these platforms, and so it's really data collection and advertising that drives a lot of that. I think because crypto natively inscribes value in all types of transactions and also data ownership, I think it fundamentally shifts or pivots like how these businesses and how these business models integrate, I think, with the future value flows. To me, I think it doesn't necessarily mean that we're not going to see even that in some ways coalesce and merge into kind of hybrid strategies where we're starting to see more on-chain metadata and associated data get correlated with maybe your real world profile and maybe even your financial data and these things
Mhm.
kind of start interacting. But I think there's a much more heavy placement and focus on, self-sovereignty and the ability to sort of own the data that you create or the value that you create. And I'm hopeful that we as a society can sort of move in a direction where, you know, the economic models that we use on the internet are less extractive and actually more, positive sum in the way that we can use this technology and sort of implement it holistically.
Well, amen to that. And I think that's a great place to wrap. Thanks so much for joining.
Thank you, Amanda.
Thank you for listening to this episode of Endgame. Please follow me on X, Amanda Cassatt, two S's, two T's. Follow the company I founded, Serotonin HQ, and listen wherever you get your podcasts: YouTube, Spotify, Apple Podcasts, the works.